Hello, I'm Brent Wilsey, and with me is Chase Wilsey. We're from Wilsey Asset Management. And you may know this, but advisors add performance to your portfolio. Now, maybe you're thinking you can do it yourself, you think, oh, it doesn't really matter. A study was done saying that advisors, and good advisors, actually add performance to the portfolio. This study was done by Vanguard Group, which is a no-load mutual fund. They say they can add up to 3% to your performance by having a good advisor. And just sticking to the plan that we lay out and stay in that track will add 1.5% to your performance of your portfolio.
Yeah, I mean, sticking to the plan is so important. One of the things they point out here is do not chase performance. What does this mean? Oh, growth stocks are hot, let's get into growth. Oh, it's time for value. It's like, that's why the average investor does not do well, because they always want to do what's hot.
Right.
And then when things get hot, they're the last one at the table. And then, it's last one at the party, I should say.
Yeah, my next Facebook. Don't do that, right?
Yeah.
And they also have to resist market timing. That's terrible. I mean, market timing gets you off track all the time. And it's easy when the market's going up. When it goes down, you think, oh, I'm so smart. I know the market's going down. I better pull out and I'll go back in when it's a better time. Not a good thing to do.
Yeah, and one thing I like to point out here too is Warren Buffett came out and said, I think his name is Howard Keynes. I know Keynes is the last name. He's a very well-known economist, one of the best economists of all time. He used to try and time the market based on economic cycles.
Right.
And he came to the realization, I'm losing money. So what did he do? He started buying small pieces of large companies. And if one of the best economists of all time, one of the brightest economists of all time, can't time the market, what makes the average investor think they can?
It's been proven time and time again, you cannot time the market. All right, let's talk about the companies that do every day for you. 3D Systems. There's a hot company before, they do 3D printers. Look back here when they came out, oh my gosh, it's going to be great. You got to get into this. I had people call me, buy 3D printers. I said, no, you don't want to. They're not making money. Well, look what happened. Boom, 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 bam, and back down again, back below where they were before. You'd never buy a hot company because it's not going to work out for you. But let's look at the fundamentals of this company. Year-to-year sales are looking up 8%, not too bad. But earnings down 352%. Not so good.
Not good there. We do like to take a look here. The balance sheet does look nice, though. That was one big positive for the company. Current ratio of 3.4, very strong. Debt to equity, 0.71. So again, essentially no debt on the balance sheet. Love to see this. We kind of took a look here, thought this was strange. Looking at December 2013, they made 49 cents. However, going forward, December 2017, they're estimated to lose 14 cents. So what happened in this time frame that they were making money and now they're losing a ton of money?
Not a good thing. What I looked at was the SG&A, which is selling general administrative expenses, up 54% year over year. There's something going on there where I like some of these things, like the sales up. I like the balance sheet. You've got to understand why their SG&A is up 54% because it's hurting their earnings right now. They've got to turn that around. What I do like about the company too is the equity is $1.2 billion. That's a pretty good equity for the company.
Yeah, that's definitely good. And one thing I always like to point out here too is kind of a rule of thumb I like to follow is the SG&A expense should not outpace sales. In this case, as you can see, 8% is way less than 54%. Not a good sign there.
A little tip that you teach people there on what to do. So, all right. Well, tomorrow, we're excited about tomorrow. It is Saturday. It's a Smart Investing Show day. Tomorrow on the radio show, we're talking about retail sales. Housing starts are coming out. We've got a lot of good things coming out we're going to talk about.
Yeah, also CPI, a big one. There's always talk about, Fed's data dependent. CPI is a big one. It measures inflation. So that's, big reports coming out next week. There's even more good ones. So make sure you tune in next week to our daily briefings because we'll cover a few of these.
And don't forget, you can listen and call in with your questions. A live call. Just give us a call at the station there during the show. We can answer your questions. You got a question about a stock, question about the economy, question about investing. Give us a call during the show. We'll answer it for you right there on air. And calls do come first on the show there for you. All righty. Well, thank you for paying attention today and so forth. And if you think investing is hard, which it is hard, it's not easy. That's what we do, is we take care of it. You are right, investing is hard. Give us a call at 858-546-4306 or visit the website smartinvesting2000.com just for a sit-down conversation, a free consultation. We'll go over what we do and help you through the maze of investing.
And make sure you go to the website now so you can sign up for our upcoming workshop on Saturday, March 19th from 10 a.m. to 12 p.m. Gosh, can't believe it's next week already.
Yes.
But it's going to be at National University in Rancho Bernardo. And we'll be showing people how to invest, how you should invest in 2016. And at the workshop, we'll be analyzing the company Qualcomm. We will be reviewing stock fundamental analysis and why it's successful. We'll be explaining when to buy and sell a stock and going over the 5 common mistakes the average investor makes.
It's going to going to be a great time. You're going to learn a lot, so hope to see you there.